Hello, my name is Jeff Tufford, and I'm with Epic Mortgage Group, and I've been doing mortgages since 2003. And I've come today to talk to you about something very, very important for homeowners right now in regard to the COVID-19 pandemic and the subsequent CARES Act, I should say. So if you could, please like and share this video. This is very important information for homeowners. Okay, so what is the CARES Act? Well, due to the coronavirus outbreak and then the COVID-19 pandemic resulting, we have the CARES Act that the government passed, and there is some guidance there for mortgage companies to help homeowners. Sounds nice. However, as with anything else the government does, there's always some unintended consequences, and there's some things in the future that we can't see. And I really want to warn people, and I would love for you to warn everybody that you know that in your family, friends, coworkers, by sharing and liking this video, because we really need to know what we're doing before we do some get into this. All right, before you take them up on their offer, I should say. So the CARES Act is only giving guidance for federally backed loans. Now that means that if you don't have a federally backed loan, none of the rules the government put in place requiring this to be handled a certain way apply. Okay, so what we want to do is look at what type of loans are federally backed. All right, you have FHA, which is ran by HUD. You have USDA, or Rural Development Loans. You have Fannie Mae, or what we call conforming loans. But Fannie Mae and Freddie Mac loans, they don't buy every loan that is conforming. They're not always sold to them. So that's something I'll mention in a minute. Then there's also VA. So you might have a conventional or conforming loan that the lender wrote in anticipation of it being a Fannie Mae or Freddie Mac loan, and it just has never been sold to them as an investment, part of the investment pool. So it's important that you know if you have an FHA, USDA, or VA, you know that it's on your paperwork. It should say that. If you have a conventional, there is a way to check and see if you have a Fannie Mae or Freddie Mac loan. You should probably just Google, does Fannie Mae own my loan? Does Freddie Mac own my loan? And you can fill out a little information and it'll tell you. Okay, but let's go over the rules of this program. So the CARES Act says basically that lenders with a federally backed loan, so let me get into real quick what the roles of different entities are in a loan. So you have a lender or a bank that writes the loan. They may sell the loan, so they're selling the investment in the loan. That would be, well, I could name some companies, but you don't know most of them. But it could be someone like Wells Fargo, Chase. They do buy loans in the secondary market to keep as an investment or to service, or both. Okay, so one company might own the investment and pay another company to collect the payment, to pay the taxes, to keep track of the escrow, all that stuff. And that is called servicing. One company may do both, but a lot of times it's split up. If a loan is sold to Fannie Mae and Freddie Mac, they don't service loans, so you'll be having another company collect those payments and do those things. All right, FHA, USDA, and VA, they are basically providing insurance to the lender that the loan won't go into foreclosure. Okay, so if someone with an FHA loan gets foreclosed, HUD ends up with that house. If it's a USDA or RD loan, USDA ends up with the house. Same thing for the VA. Okay, so they're insuring, and in all cases, the borrower is paying a fee. PMI is what we call it in conventional loans, but it's MIP for FHA. It's a guarantee fee for rural development, and it's a funding fee for VA. Okay, so you're paying that fee, and then the government entity backs your loan and protects it against foreclosure, or really protects the lender from foreclosure. Okay, so if the lender forecloses, they take the house, they pay the lender their loss, and the house is sold as a foreclosed home. So that is what it means to have a federally backed loan. Okay, whether it's federally backed or not, you're the owner of the loan, and the company that collects the payment could be different. All right, let's look at the rules of the CARES Act. So for these federally backed loans, the government says that they have to offer you or allow you forbearance. Okay, forbearance means basically you're putting off your payment. They allow that for 180 days. They will allow you an extension in some circumstances for another 180 days. But before you get too super excited about having a year of no mortgage payment, we have to consider all the ramifications. And I would love for you to share this with your friends and family before they go into something like this without considering those ramifications. So the interesting thing is there was a mortgage meltdown before. I was in that. I went through that. I kept my business going and kept doing loans through all that. And there's a lot of programs out there to help people. There was mortgage modifications. There was third-party companies coming to negotiate modifications, coming to negotiate short sales. I've run into a lot of people who didn't realize what the ramifications of those programs were. People have done deed in lieu of foreclosure, and then they come to get a mortgage, and I say, oh, you have a foreclosure on your record, and they say, no, I didn't get a foreclosure. Well, in the mortgage industry, the deed in lieu of foreclosure is looked at in the same way. Or I did a short sale. Well, a short sale is not quite as bad as a foreclosure, but it's a negative on your attempt to buy another house or get a car or whatever. That's a derogatory mark on your credit. So there's a lot of times that something is put out there to help people, but there are bad consequences. So in this case, how do you get this forbearance? Before, whenever there was a program like this, we had to have I wasn't really part of getting the customer approved for it. You would go directly to your servicer and get approved for it, but the servicer would require documentation. A lot of times they had a hard time keeping track of the documentation. People would send it multiple times. They've eliminated all that. You don't even have to really have a hardship. You just have to call them up and say, I need a forbearance due to the hardship provided by the coronavirus. And that's kind of like Pandora's box, really, to let anybody and everybody just call and say that and get approved for the forbearance. But that's what they've done because they wanted people that really needed help to get it quick. It's problematic, if you ask me, because if you don't need this, and I'll tell you why, it's going to hurt the industry if too many people take it that don't need it. So if you need it, God bless you. Get the help you need. I'll give you some alternative ways at the end of this video of how to get the help you need. Don't feel bad if you need it. If you don't have a job and you're not getting that unemployment quick enough and you haven't got your stimulus check or whatever, you have to put food on your table, you have to keep the lights on. All that stuff is important. And so if you have to take this forbearance, that's fine. I'm going to give you the ramifications so that you know what you're up against later on down the road. If you don't have to take it, please don't. And share this and like this video so that all your friends and family can see this as well and know the ramifications and know that they shouldn't take it if they don't need it. Okay, so you got 180 days and then you got another 180 days possible. All right, they have told the servicers of, again, these loans here, that there's no penalties or no late fees, so they're not going to report. I say no derogatory credit. The servicers can't report a directly derogatory remark. When I look at a credit report, I see the name of the company, I see when the account was open, I see the last time there was activity, I see the balance, I see the payment, I see the payment history, I see the last period of time, how many lates that were 30 days, 60 days, and 90 days, okay, and it tells us the date and whether it falls into one of those categories. If it's 120 days or more, that's when foreclosure starts, or repossession in cars, things like that. There's no box for that, so they put it below. They say 120-day lates and list all the dates. So they can't list a date, say your May 1st payment. If you're in forbearance, they can't list May 1st as a 30-day late. Once it's 30 days late, or 60 days or 90 days, they're not supposed to do that, okay? So the government put this out. It's positive. That's great. What are the ramifications of this? Okay, what they didn't say, first of all, there's the non-federally backed loans. They may do, the same servicer may have some federally backed loans and some non-federally backed loans. And they may put out the same guidelines for all their people. They might say, yes, you don't have an FHA or a VA government loan at all, you can still get this program, we'll still give you a forbearance. They're not required to not put derogatory credit. They're not required to have no penalties resulting from that. So it's very important. You are going to face those potentially. I can't say what every company is going to do, but the federally backed loans are the only ones that are guaranteed to not have these negative ramifications, okay? What else is there? Well, it's not forgiveness, okay? You heard the saying, there's no free lunch. That's true. There is no forgiveness. There are multiple ways they can require to get that money back. And I'll give you all three, and I'm going to get a marker here. All right, so there's basically three ways, okay? You have pay it all after the forbearance is over. You have spread it out after that. And you have put it on the end of your loan. Okay, so we have someone that I know personally that was called. She didn't call. She was called by the servicer and said, hey, we want to offer you a forbearance. She said, okay. She just wanted to hear how that would go. So she said, okay, how does that work? Well, 6 months, no payment. All right, let's just say her payment is, just to make math easy, $1,500. Okay, $1,500. So you don't have to make your next 6 payments. So 6 payments, all right, that is going to be $9,000. She gets to skip $9,000 worth of payments. Now, over the next 6 months, who would like an extra $9,000 in the bank? Probably everyone. Okay, so she said, okay, what happens after that? They said, well, after that, on the 7th month, you're going to get a bill for your mortgage for $1,500. Your normal payment, it's due. Plus $9,000. $10,500. So, sorry if you can't see that with the lighting and everything, but she said, ooh, that would be hard because if I don't have the money to make my mortgage payments for the next 6 months, why would I have $10,000 available on month 7? And they said, no problem, no problem. We'll fix that. We'll get rid of that. You don't need to do that. What we'll do is we'll add the 6 months you skipped over the next 12 payments. Okay, so for the next year, you'll pay back the $9,000. All right, so that means she's got her $1,500 payment, and she's got half of a payment for 12 months. So 6 full payments divided by 12 months is half a payment a month. So $750. So, Miss Homeowner, your mortgage payment will now be $2,250 for the next year. And she said, man, I can afford $1,500. I can get my bills paid with $1,500, but I can't just pull out $750 and make that come out of thin air. Like if I'm struggling, I don't have that. So she obviously was just trying to figure out what's going on. Didn't really want to do it anyway. But sorry. She said, well, what else is there? They said, that's it. Well, we do know there's another option that some services are giving, and that is to take the $9,000 and put it on the end of your loan. Now that's one thing that people are concerned about when they come to refinance is, okay, now I've only owed 28 years on my mortgage. Now I got a new 30 year. Exactly. You are adding length of time. On a refinance, it doesn't matter if you're going to save enough over the course of the loan, which you usually will, or else it doesn't make sense. But in this case, she's going to have another 6 payments. So if her mortgage is paid off, in 2045 in January, now it's July. And it will cost her more interest because she's got that longer period where the balance hasn't changed. Because every month your mortgage gets paid, the next month your interest is a little bit lower. Well, you're going to have a 6-month period where that doesn't happen. Matter of fact, if they add the interest to what's owed, your interest actually goes up a little bit for that period. So there's those 3 payment options. It's not forgiveness. It's not gone. It's not something that you don't have to worry about. All right, what else? Okay, we're going to talk about credit now for a quick second. They're not going to put derogatories if you have a government-backed loan. However, what are they going to put? So talking to a credit expert I know and that works for the company that we get our credit reports from, they may put an X. I've seen that before where there's no data reported. They may put an X. Sometimes we have to do a mortgage where we have to get the last 12 months history. We pull up the credit report and we see X's. I don't know what we're going to do. They're not putting derogatory credit, but they have to put the word forbearance on there. And does that affect your score? Well, the credit bureaus don't give us their formula, so we don't know, we can't say 100% what does exactly what, but the word forbearance or payment plan usually does affect the score. Someone with that on their credit doesn't have as high of a score, typically. So the next thing is when you try to get a loan, a car loan, another house, how does this affect you? Fannie Mae, one of these government-backed, one of these companies that backs loans through the government, Fannie Mae has said, if you're trying to refinance right now and the credit report or the creditor says this loan is in forbearance, you are not eligible for a mortgage. How does that play into the fact when you're trying to get a car, when you're trying to get a credit card? We don't know. Like, that's the big thing here. The big thing is a question mark. Okay? How are we, when you come out of the forbearance, you're done with the 6 months or the 12 months, you're trying to get a mortgage down the road. Is there going to be a rule that says a customer has to be 12 months out of a forbearance before they're eligible for a new loan? We don't know. The government didn't make the CARES Act. They didn't put that on there that the CARES Act is going to, can't ever negatively affect you down the road. They didn't tell us how we have to view the X's on the credit. They didn't tell us how we have to treat this down the road. There's no way to know. So after the last mortgage meltdown with people doing modifications, people doing short sales, all that stuff, a lot of that came out later when someone after doing a modification the next summer after everything's back to normal, they're trying to get a house, let's move, and we pull up their credit, oh, your last home was modified, and sometimes that was a problem. So basically the big picture here is that if you don't need this, please don't take it. All right, how is this going to affect the market? Well, obviously if there's people who can't get a new loan because something's on their credit showing a forbearance and that's a problem in the future, then that's less buyers out there, less customers, and so that's something that could affect demand and affect the prices of the housing market. There's also the fact that we have liquidity issues because the servicer who's saying, yeah, you don't have to make your payment, they still many times have to make the payment for you. So their contract to service the loan to the investor who owns the loan is, hey, if Joe and Sally don't pay their mortgage, we are still going to pay you. If they don't pay their mortgage, we're still going to pay the taxes when they're due. If they don't pay their mortgage, we're still going to pay the insurance when it's due. We're still going to pay. And if you have a big, humongous portfolio of loans that you're servicing and everybody says, hey, forbearance sounds nice, you might have to make a $25 million payment a year or a month for a year. And they don't have that kind of money. So there was a big struggle over getting money from the federal government to cover those payments. And it sounds like they're working towards getting that done. Is that going to cost them a bunch of money in interest? Or are they going to get it for 0%? I don't know how all that's going to work. But that could be a money crunch that makes the market have a lack of liquidity. Fannie Mae and Freddie Mac, maybe they don't have, through all this whole thing, if they have some liquidity issues or if the servicers have liquidity issues, we're going to see where it's going to be harder to get a mortgage. Okay, they're going to say, well, we got this huge group of people who would qualify for a mortgage. We don't have enough money for all of those. Who do you think they're going to cut out of the equation? They're going to cut out the bottom. Okay, so if we got this big group of people who can all qualify for a mortgage, and it's from credit scores, right now what we're seeing is a lot of 660 requirements. If it's 660 and above, and they say, well, we can't do everybody's loan, we're not going to have enough money, they're going to say, oh, let's go to 680 or let's go to 700 until that group of new applications is going to be small enough to be able to handle, to be able to be funded, because we can't have a lack of funds to pay for all the loans that we're closing. So it's going to possibly hurt the liquidity, and then again, that hurts the market as less people can buy homes. There's less people looking at your house if you're trying to sell, and then therefore you have to lower your price to get one of those people who's looking to buy it. So it could affect the market, and the mortgage market and the real estate market, as we've seen in the past, are hugely important to our economy. So let's see if there's anything else I can think of that's very important. Okay, so let's talk about what you can do to avoid having to do a forbearance if you can. Okay, I would say you try. I mean, there's other companies trying to do this stuff. I can't tell you if they're going to report late. I can't tell you any of that. But there's installment loans, like auto loans, companies like that are offering things. Credit card companies are giving you breaks potentially. So I would say if you're saying to yourself, I have enough money but not enough to pay all my bills, and I'm going to try to hold on and keep my credit as positive as possible and keep my future ability to get a loan as positive as possible, then what you probably need to do is start with utilities. Okay, your utility company with your power, your gas, your internet, your TV, all those companies. Hey, can I have some time to pay the bill? Or hey, can I pay you a little bit but not the full bill? And do what you can to save a little extra money for your mortgage and things like that by getting the utilities and the other like I said, internet and TV companies, your cell phone company, to give you a break, hopefully without shutting down your service. And then the second thing would be to go to your insurance company. All right, if you're not driving, if there's two people and you don't really need but one car, put one car on storage insurance. If you are driving your car and you have to have insurance, see if the insurance company will give you a break on when you got to make your payment. After that, I would go, if you're looking at consumer debt, things on your credit report, credit cards first, then installment loans like auto loans, and then last would be your mortgage. We can look at a person's credit that has credit card lates, that has installment loan lates, and we can get around that stuff a lot easier than if we look and see mortgage lates. So go to those other companies first, and then go to your mortgage. Now, if you get a deal from any of those companies or your mortgage, get it in writing. Don't Google it. Don't see what they're supposed to do. Get in writing what they are going to do if you take them up on their offer to give you a forbearance. It's very important that you know exactly what you're doing. Hey, if you want us to look at it and review your offer, we can do that. So reach out. But again, if you don't need this, don't do it, because there's too many unknowns. There's too many variables. There's too many things the government is not in control of. They're able to say don't put anything late on credit, but they're not able to say for new loans, for companies like ours, companies giving credit, they haven't said you're not allowed to look at it as a negative if they went into forbearance. So are we going to? I don't know. So it's a big issue. You know, they're not. Even if they do that, if the word forbearance hurts your credit, while we're not able to say, hey, forbearance is a problem, that you had a forbearance, it's still going to potentially affect your score, which there's a problem there. There's no way to get around. So here's the big idea here. That's the big idea. Is a question mark. We don't know. So if you can avoid it, please avoid it. We're here to help. So if you want to reach out for anything, questions, comments, concerns, we're always here at Epic Mortgage. We've been here since 2013, and we really help our clients, and we're part of a bigger company that we just all care about our clients and the community at large. So we're here to help. Reach out if you need us, but please remember that this is should be for people who really need it, and you could hurt yourself by taking it if you don't need it. All right. God bless everyone. Stay safe. Stay healthy. Do what you're supposed to do to do whatever you can to get the economy going while still staying safe. And remember, Epic Mortgage is here for you. Thank you for watching, and please like and share so that everybody sees this and can make an informed decision. Thank you.